1992. That's the last time the Federal Reserve was this divided. This just happened, and most investors don't realize what it means yet. Here's what's really going on, and what you should be thinking about right now. The Fed just held interest rates steady, no cut, no hike, a full stop. Jerome Powell issued an urgent warning. Tariff-driven uncertainty is making it nearly impossible to chart a clear path forward. Markets are reacting right now. Rate-sensitive sectors are taking the hit hardest. REITs, long-duration bonds, high-growth tech. Here's the number that should stop you cold. The dissent vote inside the Fed is the highest since 1992, 33 years. That's not a minor disagreement, that's a fractured institution. Geopolitical tensions and tariff escalation are actively distorting the economic data the Fed depends on. They can't read the room clearly, and neither can Wall Street. Bond yields are not moving in your favor. The longer the Fed stays frozen, the longer duration assets stay under pressure. Rate cuts that the market priced in for 2025 pushed back, possibly deep into 2026. That's a long wait and a lot of portfolio pain in between. Powell's 2026 signal is the real headline here. The Fed is telling you, don't hold your breath. But here's what nobody is saying about this yet. The mainstream narrative is focused on whether the Fed cuts or holds. That's the wrong question. The real story is institutional credibility. When the Fed's own voting members can't agree on direction, confidence in forward guidance collapses. And when forward guidance collapses, volatility doesn't just spike once, it becomes the baseline. 33 years of Fed unity just ended. That changes the game entirely. First consideration, rate-sensitive exposure. If you're heavy in REITs or long-duration bonds right now, that position is working against you in a frozen rate environment. Worth a serious look. Second consideration, dividend-paying equities. Companies with strong free cash flow and consistent dividend histories have historically held up better during prolonged Fed uncertainty. That's where defensive positioning lives. Third consideration, short-duration instruments. Short-term treasuries and money market funds are currently offering competitive yields without locking you into long-duration risk. Flexibility has real value right now. The Fed is frozen, internally divided, watching a tariff storm it cannot control. What does that mean for your portfolio specifically? Drop it in the comments. This conversation matters. This video is for educational purposes only, not financial advice. Always consult a qualified advisor before making any investment decisions.